Good morning. The Orlando housing market is shifting and the numbers show it. Also, interest rates get hiked again and the GDP just comes out. We'll be going through all that this morning on the Orlando Real Estate Buzz. Good morning. I'm Brenden Rendo with the Homes in Orlando team at NextHome Neighborhood Realty. And my associate, Joseph Dionne from Appli Home Loans, will be joining us here shortly. He's just running a few minutes behind. But wanted to go through a number of things this morning. The big couple things that came out in the news is, number one, the Fed increased overnight lending rates by 0.75% yesterday. And then this morning, the GDP numbers came out. And came out in a negative number, 0.9% GDP, which means the economy is shrinking, and that gives us 2 quarters in a row where we're back to back negative GDP. In other words, by all definitions, for the past 50 years, we're in a recession. No matter how you try and change it, spin it, anything like that, we've hit a recession. And what is that going to mean for our market? Could be a good situation for a lot of buyers out there. So the reason why we say that is if we take a look at the 10-year Treasury bond, which is what mortgage rates are usually tied to, that is staying steady. And give me 1 second and we'll get Joe in here. Well, hello.
You know, I love I-4 traffic.
Like I said, I'm glad you're training for a half marathon so that, I knew you hit those stairs right up them,
Just ran up them and was completely out of breath. So I had to take 30 seconds to actually try to catch my breath again.
I was just filling everybody in on the recent news. Past 2 days has been very interesting. We got the Fed fund increasing rates 0.75%, the Federal Reserve. Yeah. And then this morning, 8:30, GDP numbers came out to the negative. So by all definitions, we are in a recession.
All definitions.
Except if you're on MSNBC or any other place. I was laughing this morning. He's like, well, I'm not ready to call a recession. I'm not ready. Every expert was like, oh, I'm not ready. It's like, come on, guys.
It's funny how that works. It's like there's a clear definition of what it is. And then when that happens, nobody's willing to just say, it is what it is.
It is what it is. It's a natural part of an economy. You go up, you go down, you go up, you go down.
Yeah. The goal is, not to have massive roller coaster, make it a roller coaster ride. Just keep the flips and the inversions out of this and we'll be okay.
Yeah. So we got 2 quarters of negative GDP. Our yield curve on the 10-year, 2-year is still negative.
Yep.
So there's a lot of indications. Unemployment claims has gone up a little bit as well. So, going back, you always try and find the good in the bad. And for buyers, this is really can be something that's good for them.
Yeah.
As I texted you this morning, I was watching the 10-year T react to the news, and it got better.
Yeah.
When the 10-year T gets better, interest rates come down a little bit. And you're also going to see, we're seeing the inventory go up.
Yeah.
And we're going to go through those numbers in a little bit. And we're seeing the discounts go up as well. So for buyers, I'm thinking, it might be a good time to hop back into the market.
Yeah. It definitely, like you said, there's more inventory. We've seen some stabilizing on the rates, and now we're starting to see some things. And it's crazy because it's like we saw, yesterday you see the Feds do the 0.75 point, right? 0.75. And, quote unquote, doesn't have a direct impact. All this, hoopla everybody talks about. There's an impact to some. There's some correlations to this. But the reality is I think it was smaller than what a lot of us expected.
It was.
Like,
I thought for
0.75
sure.
so big. I was expecting a point.
Yeah, I think a lot of people were expecting a point.
Mm-hmm.
And the thing that tells me is they're more concerned for the recession than they are for inflation.
Yeah.
It comes back to that. Because interesting enough, rates took a nice little dive down last Friday.
Mm-hmm.
And it was because the European Central Bank started doing quantitative easing again.
Yeah.
What does that mean? The European Central Bank came out with a, quote, new buyback of bond program.
Yep.
Basically, all that's doing is it's taking countries with bad bond ratings and they're buying their bonds at a certain interest rate, and it's artificially propping up that market.
Yep, exactly.
And I think a lot of people think the Fed is going to push back that way too.
Mm-hmm.
My gut is they are.
Yeah.
So we really are back in that late 70s, early 80s situation of stagflation, where you've got the inflation up here and you're trying to keep, the recession minimal down here.
Yep.
Just I wouldn't want to be the Fed guy right now because
there's no real winning for him, right? No,
there isn't.
But I think you hit it is what I think we're going to see is we're going to see kind of this little all right, we're going to see rates bump up, but then we're going to see quantitative easing. Then we're going to see rates bump up a little bit. Then we're going to see quantitative, you're going to see the Feds buying back bonds and doing this, but it's not going to be like what we saw in 2020. That was just absolutely crazy. But what it's going to be is kind of this I think almost like ping pong. It's going to go back and forth, and we're going to see a lot of this just to kind of slowly bring it up now. They had that massive knee-jerk reaction that brought us up, almost double, more than double where we were a year ago. Now we're underneath that, but we're still up 80% from a year ago in rates. But I think now it's like, okay, well, they don't need to make as big of changes, but they're going to now they have that wiggle room to start playing back and forth because they didn't have it before. Yeah.
I think what they might do is they've got that, was it 95 billion of bonds they're trying to dump on a monthly basis. I think they'll pull that back. I think they'll pull that back. Be one of the first things they do is we're not going to, dump any more bonds into the market. We'll just keep it on our balance sheet for now.
Yeah.
So,
well, definitely.
Let's hop in.
When you have those bonds though, and you're dumping them on the market, who's investing in those right now?
What's the discount on those?
Yeah, they've got to be massively discounted because they're way under market rate. I guess they're going to perform forever because nobody's going to freaking sell them.
Yeah, who wants to buy a bond at 1% when inflation's sitting at 8-9%?
Yeah.
Oh, thank you for allowing me to only lose 7% a year on my money.
I'm sure there's some 401ks that are throwing these into their funds.
Probably. They're safe. They're safe.
All right, let's look at these numbers.
Let's hop into the numbers. This was interesting because we really are starting to see that shift right now. And we're seeing original list to sales price. We jumped to nearly $9,000 negative. And look at here, right across the board, it was all negative. And the numbers are bigger than last week. And this is something we haven't seen in a long time. Original list to sales price is 98% of the original list price. We're actually below 100%.
Yeah.
So you look at that. So you're saying to yourself, wow, we finally have some wiggle room here. And I think what we've talked about for buyers is get aggressive. I mean, you and I were sitting down with a client earlier this week, and she showed us a house that she liked, and there had been a $45,000 price reduction on that house like 2 days earlier.
Yeah.
That's a huge price reduction.
Yeah, 45,000, and it was still active 2 days later.
Yeah. Yeah, no one jumped on it.
Yeah.
No one jumped on it. I think we're scheduled to go see that one on Saturday. So you look at these numbers and you can see it truly is shifting more to a buyer's market. And I think with with what happened today and with rates holding steady, that we're going to continue to see that.
Yeah.
That buyers are going to have more opportunities. Take advantage while rates are holding steady.
Yeah.
Because I don't see them I think we'll see them fluctuate up and down a little bit.
Yeah.
But overall, I think we're gonna see them stay steady.
Pretty neutral or pretty consistent. I think the band that they're gonna live in is gonna be pretty small.
Yep.
The one thing that I wanted to point out and ask on and the last page was I noticed that 300, 250 to 300 and 250 and under, that's seeing the biggest drop percentage wise. Right. And I'm assuming this was a lot of people with maybe investors, starter homes. They're just saying like, hey, like this is they're seeing the market change the most because they're trying to grab as much value as they can. And it's just not there.
Exactly. And if we look at the number of sales, hold on a second. We had mentioned last week that we needed to see a couple weeks in a row where they, so we get more of a consistent feel of them. And this week, what did we see? We saw a drop again down to 470 sales. So for 3 weeks in a row, we really broke below that median line, which was actually at 600 unit sales. So sales are continuing to slow. Yeah. And if that continues to happen, again, we shift to a buyer's market.
And I see, obviously average sale price going down across the board.
That was good.
And those are big drops. But I think you're talking over $50,000 in average.
That was, my gosh, look at the average. Talk about a nosedive.
But I think you're getting some caution, some cautiously optimistic. People aren't buying at the higher end a little bit as much, or they're thinking twice before they make it. And then also on the low side, you're not getting this, and I say stupidity, but the FOMO of the aggressive offers of that market where you're offering, that 250 house is going for 280. So once that goes away, these numbers naturally are going to drop week over week.
Exactly. And our median price is slowly moving down as well. We dropped from 426 last week to 420 this week. And then we get into inventory numbers. And again, we had a smaller increase than we had previously. This is only about 50 houses. So we may see inventory levels start to level off. And that could be a good thing for sellers because we've got a smaller pool of buyers than we've had previously. Yeah. And we've got a bigger pool of homes. But if that pool stays consistent with the number of buyers we have out here, that will help us to stabilize pricing. Yeah. We won't see the big drop off that we've seen in some other places of the country. And that's the interesting part is, we had this really small pool of homes for the longest time. I remember going on my webpage and, looking for Lake Mary, this price, and having 2 homes to look at. I was like, oh my gosh. Yep. Now we're up, we've got 5 or 6 pages of homes for clients to look at, which is wonderful. And if it stays consistent with what we're at right now, with the number of buyers we're at, it's a good mix. It's a good mix. it's going to hold prices up for the sellers. The sellers aren't going to lose, but the buyers may be able to get into something with a better value than they had previously.
Mm-hmm.
Now, this one I put in today because I found it interesting watching where we're headed with withdrawn and temporarily off market.
Mm-hmm.
We're seeing people starting to take more of their homes off the market. Those can be frustrated sellers that, hey, the house has been on for 60 days, not getting any hits, no offers, things like that. Mm-hmm. Same thing with the withdrawn is there's some, the seller's gotten frustrated to a point where there's like, you know what, I'm out. Mm-hmm. I'm taking it off. I'm not gonna try and sell it. I'm gonna wait. And you see that trend over the past couple weeks where the numbers are going up.
Mm-hmm.
And this of course declines the number of inventory that we have. Then when we get into the condos and the townhomes, we're into the same thing. Again, we're pretty much negative all the way across the board on original to final sales price.
Mm-hmm.
So we're seeing a trend in the market. This is the trend that we've been looking for.
Yeah.
And I just wanted to pull this up because what I did is I pulled last week's numbers compared to this week's numbers.
Okay.
I just wanted to, because I was looking at them going, wow, that's a lot, and you see the previous week was at 516 average price and we're at 486. That's a $30,000 drop.
Yeah.
And our original list price to sale again, it's about a $1,200 price adjustment. So that tells me the days on market is longer. Sellers are starting to get frustrated. Sellers are willing to do a little bit more than they had previously.
Yeah, I definitely think that transition of people that are, and you're showing it across the board. We have more temporary off the market, withdrawns. These are probably people that are like, hey, I'm going to throw it up there, and if I can get 600 for my house, I'll sell it all day, and their house may only be worth 520 or 550. And they're realizing, wait, this isn't going to happen. Mm-hmm. And then conversely, those that do need to sell are realizing, hey, we might have to play ball now. We don't call all the shots. Yep.
So it's a nice shift. Mm-hmm. It's not dramatic. It's not the floors falling out from underneath us at all.
Yep.
It's just a shift. And I think I can see us steadying off in this area, especially with the rates starting to level off, because we've really been kind of consistent for about the past 3-4 weeks.
Mm-hmm. Yeah, pretty consistent. We've seen it kind of, like you said, bounce. It's a little hair lower probably over the last 3-4 from 4 weeks ago, but it's not massive differences.
Yep. So I mean that's really where the market is sitting today.
Mm-hmm.
So it'll be interesting to see how everyone reacts to the 2 quarters of negative GDP.
Yeah.
The Fed, because we're coming into November with the elections.
Mm-hmm.
I don't think the Fed wants to do anything any more drastic before an election.
I think we're going to see that slow down. It is actually really interesting time. We're getting into July. You're talking student loan. The pause is supposed to be lifting. In August. Okay. So that's what is there going to be an impact on that? We've got the actual numbers for all definite is if we're in a recession based off of as defined. But from a housing perspective, it doesn't really usually, most of the times a recession isn't bad for housing,
No. You still get the consistent 2-3% growth overall. And usually for rates, it's a benefit to buyers. Yeah. Because there are less buyers.
And so I definitely think we're in I think coming to the end of July, I think the next 2 weeks as we enter into like mid-August or, August 10th, I think it's going to be really, really interesting because I think that's where we're going to see what type of policies or what type of changes that are going to impact, there's a lot of talk about student loan forgiveness or not forgiveness, or are they going to extend it out again? Like, I think they'll probably extend out more, versus make a decision. I feel like at the end of the day, I think, no decision will be made before election type thing. I think they're just going to kind of pause it unless it's going to be a massive, like it's going to be something that's going to be so over the top for one party, it'd be the Democratic Party that would have the win in that situation if there is any type of forgiveness. So I think that can be a driving force because what they do with that's going to impact, what people qualify for, if they did the 10th, I've got borrowers right now where if they forgave if the government forgave $10,000 in federal debt, a husband and wife with 20K, they may qualify, you're talking, they could be qualifying for an extra $40,000 home if they didn't have that debt on their credit report with different loan programs. Like that's like if they do this, it could have if they forgive, it could have a positive impact. If they start doing payments, I don't think it's really going to have any impact because most people that aren't making payments right now are just going to go into like an income-based program or something and still not make payments. And the ones that are making payments, they're not going to see a change because they're already making payments.
They're already making their payments.
So it'll be interesting to see. But I think a lot of what the feds do, what the government does now as we enter this is going to have a really, we're not, I almost get the sense that we're not going to see the reaction this week. If that makes sense.
No. I think everyone knew that a rate hike was coming. I was surprised Wall Street liked it as much as they did, that when they only went 0.75, I thought they would have looked at it and gone, wow, that wasn't enough. But we could also, with a slowing economy, the slowing economy can pull prices down and start a deflationary process. Anyways, look at gas prices over the past month. They got so high, people just weren't driving as much. So demand goes down. So demand goes down, what happens? Prices go down. So it's one of those is where when you look at the total numbers, the numbers besides the GDP, is you see that personal spending is tightened overall. People are just sharpening their pencils before they go and spend on anything, and that's the whole thing with the recession. You're spending less. So I think that will help stabilize things. It could help us actually have a very short, very low dip type of recession, which would be nice for everybody. And the job numbers are still strong. That's the brightest spot. Even though we had 5,000 increase, that's really not a lot. We're still basically at a full employment economy. As long as we can stay at that full employment economy, that's going to help alleviate a lot of the stress of a recession.
Yep, absolutely.
So, well, everyone, thank you for joining us, Joe. Glad you can make it. If you like it, please Facebook thumbs up, YouTube hit and like the subscribe, and we'll see you all again next Thursday. Take care.
Have a good one, guys.